So today I want us to go through government boards and how they work. That is government boards and treasury bills. Much of it will be more of theory so that we first understand what boards are, how they work. Then hopefully the next time we should be able now to go through the practicals in terms of how you apply. For those who have not opened account with CBK, I've already done that video. I'll be sharing that link. I don't want us to go into details of account opening in the interest of time, but now the next training will tackle opening a CDSE account for CBK, how you get approved, and after that now what are the steps. But today we'll go through that in form of theory parts. Then once you understand how boards works, I think the rest is pretty simple and straight. Let me briefly turn on the camera for those who may have not seen Peter before. So my name is Peter Chega. I work with AIB Access Africa. I started this community, my website KE, just to bring this information out. And it's not affiliated with any broker, so that everybody have access to this information for free until such a time that you are able to trade on your own and invest on your own. The key thing here is creating wealth. Creating wealth. So let me turn off the camera because of latency. So as the heading says, today we are going through government boards and treasury bills in a beginner series so that we understand all the terminologies, what they are, how you apply, and how to get a good board. Remember, as I said, when we are training equities, that is shares, how you can buy shares at NSE, I always insist, a broker is there to make money. So today you'll understand why. If you have to call a broker, well, they will tell you not to go for primary market, why you need to go for secondary market. Primary market, there they don't make money. And ideally, you might be overpaying. And when you're putting your money, whether in shares, whether in boards, whether in international markets, money market fund, and special funds, in pension, you are doing that to earn extra coin. If charges it into your returns, then there is no need of investing in that product. So today you understand the difference between primary market and secondary market for boards. You also understand how to identify opportunities in government boards. Why am I doing these trainings? Very soon you see in AIB DigiTrader, you'll be able to buy government boards. You have the pricing and everything. If you don't know how to interpret those pricing, you might end up overpaying. And at the end of it, you realize you didn't even get the gains you are looking for. It's very important you understand those pricing, how to compare each board, why you'd want to go directly to CBK instead of going through the broker, or through the broker instead of CBK directly. Once you understand that, the returns, how they come in form of coupon and also yield, you'll now be able to select the boards. So again, for those who have just joined, my name is Peter Chega. That's my WhatsApp number, 0723384775. And the community is my Wealth Guide KE for those who may be new. So let's start with how the boards work. That is government boards. So when you're buying a government board, ideally what you're doing, you are lending money to the government. It's not like in shares. In shares, when you buy shares, you know you are becoming a shareholder. When you're buying during IPO, you are giving your money to company to do whatever they want to do. They will not pay in interest. It is you to decide, do I want my money back? Now you come to the secondary market, NSE, and sell your shares at a profit. That is shares. If you need your money back, you have to sell those shares at NSE. There is no other way out. unless when a company is being bought out. When company is being bought out by another company completely, then you as the shareholders, you are told you'll be paid certain amount. Those are the only two ways you can get out of NSE. Either sell your shares in the market, or a company buys out the whole shareholders, including those who bought through IPO and also NSE. That time you are paid your money back. Now, on the other side, government boards. Government boards is where you lend your money to government. You're actually lending money directly. When you're buying through pre-money market, you are lending that money to the government to do whatever they want to do with it. It could be paying debts, or maybe if it is infrastructure board, maybe they want to build a road or something. So you are lending your money. In exchange of that, the government tells you will be paying you interest annually. They will tell you even the interest they will be paying, the annual interest. That interest, however, is paid every 6 months. You have not sold the board, your money have not changed. If you gave 100,000, that's what they have. If you gave 1 million, that's what they have. Out of that 1 million, they decide we'll be giving you an annual interest, let's say, of 10%. Then that 10% is divided into two. Every 6 months, you get half of it. The next 6 months, half of it. Then at the maturity, you get back your full amount. This is different from shares. Shares, I said, your money is there until you sell or you are bought out. Ideally, you are selling out. You have to sell out to get out of NSE shares. Government boards, you either wait until maturity where you get your full money intact. That is if you applied through primary market. If you are buying through a broker, however, the price could be higher or lower. But again, at maturity, you won't get what you paid. You get the value of the board. If it was supposed to be 100,000, that's what you get. So for boards, it's different. It's not like NSE. However, in between, you can decide to sell your board again to get back your money. So for government boards, there are two ways you can get your money back. Sell in secondary market through a broker. So you buy a board either on primary market or secondary market. Once you buy, you have it for some time, you decide you want your money back. That time you can come and sell through a broker. It's not, you can't do it directly. You have to go through a broker. However, you can decide to wait until the board matures. At maturity, when the period ends, you can decide now, this is the time to get my money back. The government will divert money back to you intact, plus the final interest. So for government boards, you are lending money to the government. The same way you take a loan. It's now the government taking loan from you. So the government will agree, will be paying you interest. It could be 10, 13, depending on the board. Then at the end of maturity, they agree they will return full money back to you. And then the government defaults, yes and no. If government defaults a local debt, it means even like IMF and the others, they won't give them money. That's why government linked boards are very safe, because government want to maintain that international image. Ideally, they will still return your money back. If they are not able to do that, they will do something we will see at the end called switch auction, where the board you are holding, you are told by the government, can you exchange with another board, and you continue holding for some time. So you see that at the end. So basically, you get your money back in full. If government is not able to return that money back, they usually float something called switch auction. For the same board, now you are told, we want you to move to another board. We extend period. You still continue earning your interest. However, you can also decide to get your money back. You don't want to move into the switch board. So the structure of the boards versus treasury bills. So we have two types. There is the treasury boards, and there is the treasury bills. So treasury boards are long-term investment. This is why you loan government for a duration exceeding 2 years or even 1 year. It will depend on the duration the government have given. So treasury boards is where you hold for or long term. And it pays interest every 6 months. And they're usually good for steady income because you have given, let's say, 1 million to the government. That 1 million, they say, will be giving you an interest, let's say 10%. That 10% is calculated with the principal, the amount that you loaned. That is now annual interest. It is divided by 2. Every 6 months, you get that amount. It is not paid to the broker. It is paid directly to you. When you're opening a CBK account, for those who have seen that video which I did some time back, but we will do next week, full process of opening a CBK account for those who have not seen. There is a bank account you give. That's where the interest is paid. So it is sent to you. You don't need to do anything. If they say the interest will come on 6th May, that day is when you receive that money in your bank. So that interest, it will run for the duration of the board. When it matures, the board matures, you get back your full amount. If you gave 1 million, you get back 1 million. Plus the final interest. Remember, there is the remaining 6 months before maturity. Those 6 months you have to be paid together with your principal. You can decide to sell in between. It's you to make that decision. Do you need your money back in between? Go to a licensed broker, ask them, I want to sell my board. What is the process? They'll give you the pricing. If you agree to the pricing, they go ahead and execute. Now you'll be paid back your money, not by the broker, but by CBK. So you exchange board with somebody else. What does that mean? It's just like shares. When you give company money, you can't go to that company. When you're buying shares, you can't go to that company and ask them to give you back your money. You have to sell those shares in NSE. The same thing with the board. You have given the government, it has invested or paid it. If you want your money back, what you'll be telling the government, and do the project or return back the loan you had, first pay me my money. That's why there is that secondary trading, where if you want your money back, you can sell to somebody else. They continue earning the remaining interest for the remaining duration, you get your money back. So a good example, let's say the minimum usually is 50,000, but always check on the circular. They usually give you the minimum amount, and even they are called lots. Lots is like the same way we buy shares in multiples of 1. The same thing. If they say 50,000 is multiples, then if it's 50,000 minimum, you add 50,000 like that. 100,000, 150. So if you have to apply either 50, the next amount you can apply is 100. The next one is 150. So it goes in multiples of 50. Why? If they do less than multiples of 50, it means if you buy a board of 50, let's say 90,000, and you want to sell it, let's say you sell 50, you are left with 40. 40 you can't be able to sell. That's why it goes in multiples of 50. So if you invest the 50,000, it will be earning regular income every 6 months until maturity. So let's say the board is 10% coupon. Coupon is the interest. So you just multiply 50,000 times 10, which is around 5,000 annual. That 5,000 you divide by 2. So every 6 months you're getting 2,500. The next 6 months, 2,500. It will run until maturity of that board. Now, when this board matures, assuming it is 15 years, so you add 15 years from the time the board was floated, and in the circular, they usually even tell you the maturity date. That day the board is maturing, you will get back your 50,000 intact, plus the final interest of 2,500. So that's how treasury boards work. Now we come to treasury bills. They are usually called T-bills. So if you talk to a broker and they tell you T-bills, those are treasury bills. These are short-term loans to the government. It's usually either 91 days, 182, or 364 days. That is 1 year. They are short-term. However, They are not like bonds. They don't pay interest. Treasury bills don't pay interest. What you do when you're buying that, when you're owning the government, you actually buy at a discount. So let's say a good example, you're buying a T-bill at 95,000. Huh? So you pay 95,000. But after 1 year or 91 days, you'll get 100,000. Now the difference of 5,000 is what is profit. So for T-bills, you pay less, but get full amount on maturity. So if you're buying a T-bill worth 100,000, you pay 95. So the 5,000 difference is what you get at the maturity. So you get 100,000. Treasury board, you give the 100,000 to the government. They keep on paying interest. At the end of the maturity, you get back your 100,000. That is treasury board. Treasury bill, 100,000 is what you get at maturity, but you pay 95. You're paying a discount. The duration also matters. Treasury boards, long term, but you can sell in between. Treasury bills, 91, 182, or 364 days. Then what do you need for you to invest in either? You need a CBK CDS account. That CBK CDS account is different from CDS account for shares. CDS account for shares you open through a broker who opens directly at CDS. For CBK, it is you as the investor who opens directly with CBK. So you just log into those CDS platform. It could be the app or portal. Submit your KYC details. That is, know your customer details, your names, date of birth, your locality, and any other details that you ask, including bank details. Make sure those details are correct. The mistake we make even in shares is where Peter is called Peter Shege Mogo, but when I'm opening, I just put Peter Shege or I put Peter Mogo. Those two people, those actually three people are different. Peter Shege Mogo, Peter Shege, and Peter Mogo are totally different. Those are not the same people. I am the one opening the account with Peter Mogo. I can go ahead and open with Peter Shege. I can go ahead and open with Peter Shege Mogo. Those three people, as long as CDSC accounts for boards and shares are concerned, are totally different individuals. Why? Government have your data in the IPRS that is linked to your ID. The details that are in that ID are what you're supposed to capture, the way they are captured. First name, first name, last name, surname. Capture them as they are. Otherwise, your application to CBK will be rejected. You will have to redo again. Now, contrary to shares, CBK you only open once. Shares, if you go to another broker, if you have opened account with the IB, you go to another broker, they will use the same details you had with the IB but open a new account. So you find at that point, broker may check the other broker the way they open the account, and they will tell you maybe the account was opened wrongly. Go to that broker, rectify your details, come and open account with us. That is shares. What about government boards? When you submit your application, immediately they check, is this ID number linked to you? Yes. What are the names you have given? What are the names in government database? If they don't match, they reject that application immediately. If they match, they go ahead now, check the other details and proceed to open account, and you get a CBK CDSC account. It is different from shares one. Now, the other difference is a board, a treasury bill. You can open with the IB access. You can buy directly from CBK. But when you're selling, it's not a must you sell with a broker you have with the CDSC account for shares. You can go to another broker, even a board dealer, as long as they are approved and regulated by CMA. So that is the difference between boards and shares. Shares you sell with your broker, the broker you bought with, unless you transfer. Board, you are not limited to a broker. Even if when you're opening account, there is option of selecting broker, you are not tied to that broker. You can walk to any board dealer who is approved by CMA and have access to NSE trading system for boards. They can easily sell for you. So secondary market for boards, it's not tied to any broker. As I said, the reason for this training is because you will start seeing now platforms for trading boards. AIB is one of them. We'll be bringing boards hopefully mid-May. I don't want to give the exact date, but by midday you start seeing it on the app and portal. When you buy that board, remember you must have a CBK CDS account. That's why I'd want you, if you intend to invest in boards, open a CBK account area. Have that account with you. Give it to your broker, they add it into their platform. That way now you'll be able to buy direct through the platform. Primary auctions, you come to that one you do directly with CBK. So in terms of buying and selling a board, you are not tied to any broker or any board dealer. If you have been working maybe with Peter as a board dealer and you want to move to Mary or Jane or Paul as a board dealer, you can easily move without filling any forms. You just tell them, I want to sell this board, give them the details of your account. It's them to handle that headache with the CBK how to access your board. If there is any now requirements, they will tell you what to sign. But as long as treasury boards and treasury bills are concerned, they are not tied to any broker. No broker should tell you you can only buy with us and sell. If a broker tells you that, then you are buying under something called omnibus account. That is in CBK, it is the broker who owns the board. The same way we have ZD. I know you have seen most board dealers, let me call them board dealers, however they are brokers, telling you you can buy boards with us, even a bank, without having to open an account at CBK. It's not you who owns that board, it is them. They have an omnibus account. That account is tagged through a custodian. You must have a custodian at that point. The custodian now is the one who knows you. If it is a bank custodian, they will have your name and everything. But at CBK, CBK only knows that account for the broker. At that point, now you are tied to that broker. So it's very important when you are trading on treasury boards and treasury bills, make sure you're opening directly at CBK with your name. You own that board for the maturity, and it is you to decide whether to sell or even to add more. But remember, if you're adding more, it's not like shares where you buy 50, then you buy another 50, it becomes 100. No, every amount is a board on its own. No? So that's on treasury bills and treasury boards. Then how do you make money with boards? In shares, we have said it is through dividends. Mostly, if you buy dividend share stocks, or you buy raw and sell high, capital gains. Now for boards, it's a bit different. It's coupons. Huh? These coupons are the interest you get without selling any board. Now, interest in boards is like dividends in shares. You are being paid to hold on to that board to maturity without selling. Huh? And it is paid every 6 months. However, and that's why I have not included here, you can sell in secondary market. That is not guaranteed you can get a good rate that will give you higher returns. So if you are planning to sell to buy a board and sell in the secondary market, you have to be wary of broker commissions, levies, and also price movement. Remember, nobody would want to buy a board that is giving 10% interest from secondary market, where they can get the same or better interest in primary, where they are not paying anything. So you have to be aware of that. Huh? Don't buy a board without knowing how the prices move in boards. You might be robbed for the duration of that board, or you sell at a loss. Huh? So a good example, a board of 12%, and you have invested 50,000. So again, 6,000 per year, but paid semi-annually. So you divide the 6,000, which is interest per year, every 6 months, you get 3,000. Huh? So these allows you fixed income. That's why they are called fixed income. Boards are also called fixed income. Why? Because this interest is fixed. It doesn't change. If a board is 12%, even if interest rates keeps on changing, coupons don't change until maturity. I know that will confuse those who are in the market. It is the yield that changes if interest rate change. And what does yield mean? The price of the bond if you are buying or selling. That's what changes. But in terms of what you get for holding up to maturity, it's called interest, which you get every 6 months. That does not change. That's why you find the people who want that stability and also comfort in investment, most of them they go to bonds because they already know when they are buying bond, this is what I expect every 6 months. At maturity, I'll get my money back. So they are able, you are even able to compute the interest, the total interest you get for holding that bond to maturity. So fixed income, it doesn't change. Predictable because you already know by in advance even before you buy. Because these circulars, they are sent very early. You have enough time to make decision whether to buy that bond. That income is predictable, as I've said. You already know in advance this is the interest I'll be getting. However, those returns can only be affected by withholding tax. If government changes withholding tax for those boards that attract withholding tax, infrastructure boards they don't, but the others they attract interest or withholding tax on the interest. So infrastructure boards, those ones they don't have any withholding tax. The other boards they usually have, so you only need to factor that. That's the only thing that can affect your returns because it depends on the government. If they change their tax, if it affects the boards, then definitely your returns will be affected. Then we have treasury bills. Treasury bills, we have said they are short term. Short term, 91, 182, 365. You give money at discount, you get full amount on maturity. That is, if you're getting 100,000 on maturity, you pay 95 now. So the difference is what accounts for your returns. So for treasury bills, the way you make money, there is no interest in between. But you buy at a discount. You buy lower, then at the end you get full amount. So these ones, they're usually simple because you don't need to calculate anything. You already know, I'm giving 95, I'll get my 100,000 in the next 91 or 182 or 364 days. But that's just an example. It all depends on the settings of each T-bill. They are also short term. You don't hold for long. Within 1 year, if the highest, I think it's usually 365. Above that is they are usually boards. So a simple summary: boards you earn through interest every 6 months, unless you want to sell in between. But again, always check the price you are selling at. T-bills, you buy at a discount, get full amount later. But all of them, ideally, you are lending money to government to earn a return and expect your full amount on maturity. So the difference is treasury bills, again, short term, duration less than a year. They don't pay interest like bonds. You only earn through a discount. Treasury bonds, on the other side, they are long-term investments. Duration depends on the duration of the bond, and you always know even the maturity, and you get interest, which is also called coupon, every 6 months. So why would you want to invest in treasury bills? If you have short-term goals, maybe you have some money, let's say you have 90,000, and you want to keep it somewhere where you'll get the full amount back. So you can keep it in treasury bills within the duration for that T-bill. At maturity, you get now plus now the full amount. If it is 100,000, now you get 100,000. Remember now there is that difference. You paid 95 or 90, you get 100. So the difference of around either 5 or 10 could be your returns. They are simple and low commitment. There is no much of calculations here. Treasury bonds on the other side, that's when you want steady income every 6 months. And they are mostly suitable for long-term investing, where you keep putting your money in, expecting the full amount back. So within the duration of that bond, you still be earning your interest. So when do you choose treasury bills? One, when you need money in shortest time, less than a year. So you want to park that money somewhere. And maybe if you compare the returns between treasury bills and money market fund and shares, you find treasury bills will be better. Because maybe money market fund, they are giving lower returns. And again, even in money market fund, nobody should tell you, you can also lose money. All the investments, they usually carry risks, only that some of them, they are lower. So you find in money market fund, maybe fees and interest rate may change, and you realize you might get lower returns. That time you can come to treasury bills. Maybe NSE is affected, prices are way too high, and there is no further price rise that you can expect. The next thing you can expect is a down trade. Instead of putting in shares, you can put them in treasury bills, wait for the market to stabilize. By 1 year, you can withdraw now plus your discounted value. You come back to shares. Where you don't want long-term commitment. Remember, for bonds, once you get in, you can only sell in secondary market, and you can end up selling at a loss or at a profit. It will all depend with the prices. So if you don't want to commit for a very long time, then go for treasury bills. And where you prefer a simple structure, where you already know I'm putting this amount. I don't want so much mathematics. What do I expect to get at the end? It's this amount. That's it. When then do you select treasury bonds? Where you want regular income every 6 months. You have shares. You have already invested in shares. They are giving you good dividends and everything. Now you have decided I want to diversify from shares. Then you realize I already have a money market fund or a special fund. I don't need to invest in it. I need a third option. Come now to treasury bonds, where every 6 months you're getting return. When you get that interest, as we said in shares, don't use it for your personal bills unless you don't have another source of income. Use that income now to build your shares. Build a good portfolio, dividend with this interest. So you invested 1 million or 100,000 or 50,000 in a bond that is giving you interest. Use this free money now to build your portfolio for shares for long term. These shares you are buying, they are giving you dividend. Again, use that dividend to continue growing your portfolio. So basically, you are recycling your returns within the same ecosystem. From bonds to shares, dividends back to shares. At one point, you find with a bond, which is still giving you returns, you have built a good retirement portfolio. Then when you're investing for long term, that is, you have money that you don't anticipate to use in the short term. Let's say you want to build, maybe you have bought a plot and you're anticipating to build that plot maybe in the next 5-10 years. And you realize holding this money for all that period, I may end up using it. Anything can happen in between. Then what do? Come and put it in bonds. Let it keep earning. You get your money full intact plus the final interest. So you get back your full amount plus the final interest. Now you can use that time to build. So bonds are good for parking money that you can use in long term. You can also bring that money in shares. But now the difference between the two is that shares you might be tempted to sell in between. Then you have access to the system. You can go and execute, get your money back and use. What about bonds? Before you even get somebody to sell to it may take some while. It locks that money in for the purpose you are intending to use for. So that's why treasury boards, just think them not just in terms of returns, because most of us usually compare shares. What is the return? You do dividend yield and maybe estimate capital gains. You go to money market fund, you have your net interest. You come to special funds, you have your net interest and boards. You are trying to compare all of them. Boards is when you have a long-term commitment. I want to buy a car in 5 years. I have 1 million right now. Maybe that time prices will have gone down. Or maybe you anticipate you're outside the country, that's the time you'll be coming back and you want some money to come and use, just pack it in bonds. The interest that is paid to you directly, that one now you can decide maybe to use it. Remember, when that period lapses, you get your money intact. Money market fund, you can withdraw. Even if they tell you there is a lock period, it's only that they tell you there is a penalty. If you need money urgently or you are tempted to withdraw, you actually say, I will even pay that penalty. You can withdraw. Shares, you can come and say, what about the board? You have to look, broker have to look for somebody to sell to you, to sell to. At that point, you may realize it's better to hold it to maturity. So it helps you lock that money for a long period. But in terms of selling, it doesn't mean you can't sell a board. You can sell as long as you accept the terms that will be there. Where you want a predictable cash flow, that is, you already know every 6 months, June 1st, I'll be getting my 10,000. December, 10,000, without hustling. And remember, you want to diversify as much as you can. Where shares are giving you they are giving you dividends in different months. You have now boards which are paying you interest in different periods. So you already have a good cash flow. And when you are able to hold for long term, nothing stops you from selling in between, but it is a process. And you have to accept some reality that you might end up selling at a lower price. Boards, unless you really get good prices, if you have to sell, in some cases you might end up selling at a loss. Why would somebody come to a broker, pay commissions and pay everything to buy a board where they can get the same board directly from CBK without paying anything? And maybe even the returns in terms of interest is the same, coupon is the same. So the only difference here is the amount you pay. One, it's fixed. If it is 100,000, you're paying 100,000. That's directed to CBK. If you're buying to the market from the market, then you're subjected to the market rates, prices, which now determines the yield. That is the returns you get for holding that board you buy from the market. We'll come to that. So the simple way to remember all these: TB short term, you get it discount at the end. Treasury boards hold long term, earning interest during the duration every 6 months. So always when you're investing on either of them, always look at the time horizon. Even when you're buying from the market, we'll see. If you're buying from primary, remember you are entering the first time. You have to hold for the duration if it is 15 years. Maybe in the secondary market, you have a board that is about to mature in the next 5 years, giving the same returns, which you can buy with a lower price. Meaning, first of all, you get at a discount, then you earn interest for the remaining 5 years and you get your money earlier. So the reason why you'd want to buy from secondary market, get the board earlier, get your money back earlier, but you still earn that interest. So for boards, it's when you are looking at long-term income. So we come to the process. You can't buy a board if you don't have a CBK CDS account. If you invest a board and you don't have a CBK CDS account, it is not you who owns that board. I went through this process. Unfortunately, on YouTube, they flagged the video. I uploaded on TikTok, but I've been editing it. I will come and upload on YouTube. You only need either to download the CBK Do CDS app or on their web portal. Just go to CBK website. Submit your details. All the details that are requested. Make sure your names is they are in your ID. If first name is Peter, first name put Peter. If second name is Chege, put the last name is Chege. If surname is Mogo, put as Mogo. Don't try to omit anything. It will be rejected. Don't try to interchange. It will be rejected. It's only that in shares, it is us who do the manual verification. We also have automated verification. If we are to activate that, I can assure you most of even CDS account at NSC, they will be rejected because we usually see people omitting the name or interchanging. And when you ask somebody, they tell you, this is how I arrange my names even anywhere else. As I said, in CBK and NSC, if you were to proceed and open that account the way you have given those names, you and that account are totally different people. And you'd have a very hard time. That's why giving correct details is important. For broker accounts, I know there are brokers who bypass checks, they just proceed and open. For those who have been done that, you already know the process. It is a hectic one, especially if you have a broker who is not responding. For CBK, on the other side, they don't open. It can't proceed. So make sure the details are correct. Then you just wait for approval. You get it via email. And once that comes in, you are able now to start buying bonds. So we'll go through this next time because I want us to go through a bit of theory. For those who have bought the ebook, let me even share. For those who have not bought, let me first share that link. Let me get it quickly. I would have a scenario where you are able to buy the board and making the decision on your own. Huh? Why? As you see at the end, brokers can easily take advantage of you. In primary market, a broker doesn't earn any interest at all. In primary market, when you buy directly from CBK, a broker doesn't earn any commission. When you buy through them, they get commissions. So if you go to a broker, the best thing a broker can do is to tell you buy from secondary market. Even if that board is expensive, they will tell you buy from secondary market. I've never seen, I'm sharing that link. So that is the link, that's where the book is. For those who have not bought that book. And I'll be breaking that book now into practicals. So when you go to a broker, the broker will not open a CBK CDS account for you. They will tell you to go to CBK app or portal, register, submit your details, you get the approval. When you come to them and you ask, which board do I buy? They will actually put an NSC price list, give you, and the pricing of the boards. You select one. They will not tell you there is a primary board. Why? At primary market, brokers don't earn any commission. So they will push you to buy directly from the secondary market where they make money. Whether the rates are favorable or not, it's not the role of the broker. That's why checking availability of boards and T-bills is very important. You as the client without relying with a broker. This information is always there. On the account that you open, you see all the listed boards which are in the primary market and also in the secondary market. In NSC price list for boards, you have all the boards that are trading. And you can see even those ones which have traded, the ones which are actively trading, so that you don't buy a board that is not actively trading and you are held to maturity and maybe you wanted your money in between. CBK website, they have everything. CBK, they also have a WhatsApp channel where you can get all this information. The first thing you look at is coupon or interest rate, because that is your returns for holding that boat to maturity. what interest will you be getting? That's the most important. Coupon interest rate, note what it is. Then maturity, that is the duration of the bond. You don't want to buy a bond in secondary market that you hold for, let's say, next 15 years, yet in primary market you have a bond that you can hold for 10 years. You'll be paying, remember in secondary market we have said you'll be paying commissions and everything. You are actually paying higher than in primary. Also, you on the other side, you don't want to buy a bond in primary market that gives you a lower, let's say even the same coupon with the one you'd buy in secondary market. The duration is longer than the one for secondary market, and again, maybe in secondary market you are paying less. Broker may not give you this. Why? Because immediately you compare primary and secondary market, what you're telling the broker, I don't want to give you my commissions. I can easily go directly to CBK. No broker would want that. So they will try and give you two boards which are trading in NSC, give you comparison, and without even checking, you end up overpaying. Then also check auction data so that you are not left. Then you need to decide, out of now the list you have received, bonds and T-bills, where do you want to invest? Is it treasury bills? Maybe you have seen the discount, the amount you pay now plus the amount you get on maturity, maybe that gain is higher than buying a bond, then you better go for treasury bills. Maybe you have computed the interest that you get up to maturity and you realize it's even better to go for a bond than treasury bills. You also compare different bonds. They have the same maybe interest, or there is one which is higher, but holding that bond maybe you're holding for the next 2 or 3 years. Why would you want to buy another bond that you're holding 10 years? Well, you can get a shorter one, maybe at a good rate, and same interest. Remember, the interest will not change. Coupon is fixed. If it is 12%, all of them 12%. What matters is the price you buy at. So what you consider, how long you invest in that bond. Always check the duration of that bond. It is if bond is FXD, then some numbers 2026, the year it has been floated, and then it has stroke 0 something. That is the duration. Then your expected returns. Let me briefly open one of the prospectus, the one that was done some time back. Let me see if I can get that quickly. It can help explain these terms. I will use the one that is on my ebook. Yeah, it is here. Let me use this. I will use the one on the ebook so that it is clear for those who have bought the ebook. You are able to follow up. Where is this? Yes. Let me zoom in. So these are board. I think they have already closed. So these are two boards. The issue number. It has the first part of the board, then the year, then the last part where there is 030. That is the number of years. So from 2011 you hold for that years. If you go to FXD 1, 2026 is the year that board is floated. Then for which number of years? 030. So for that years. So basically you are comparing holding this board that was opened in 2011, holding for the remaining duration, against a board that is reset this year, holding it for 30 years. Where is that date? Look at the maturity date. It is there. Where is it? 1, 2, 3, 4, 5. After withholding tax, one is maturing in 2041. The other one is maturing 2056. Both of them have the same withholding tax. 10, 10. Coupon, one 12%, the other one 12.5. So here, If it is these boards, you are deciding which one to buy. There is one that you hold for 15 years, get your money early. Or there is another one that you hold for 30 years. So do you want to still hold a board for 30 years? That is, government holds your money for 30 years, and the only difference is 0.5%. So those are some of the comparisons you do. So the reason why they have withholding tax is because these are not infrastructure boards. ISN number is a number at NSE to identify that board in their trading system, just to give the correct prices. Then the tenor is the number of years you hold that board. So like now the one for 2011, it's remaining with 14.9 years to maturity. You are not buying directly from the market. Like this one, it is reopened. You just apply. Then we have the auction date. That is the date the government will determine who get the board based on the settings you select. Because there are usually two types of bidding, either non-competitive or competitive. We'll come to that. For non-competitive, you get automatically if it is not oversubscribed. For that is for non-competitive. Competitive, it depends on rates you give. Then as you can see there is the amount they are planning to raise, and again there is a minimum for each. Competitive 50, maximum that is 50,000, maximum 50 million. For competitive bid for this one is 2 million, depending on the board. So that is just a quick overview of the boards. Let's go back to the presentation. Let me close this. We'll come to that because still I need to use it somewhere. So you have seen, you get these details up front. How long to invest in a board? You have seen one is close to 15 years, the other one 30 years. Expected returns, one coupon is 12, the other one is 12.5. So you make decision, which one do I want? Now in the primary market, that is when you are buying the board not directly from NSE, but from CBK. You place a bid. I will not go through this today, we'll go through it next week. You just log into the app or after you have opened account and you are approved. You go to where either boards or T-bills. You choose the one you want, the board that you want to bid for. Select the type of bid you want, whether it is competitive or non-competitive. But remember, for competitive, you have to abide with the minimum. Even for non-competitive, you find most of them is 50,000 minimum. For competitive, they tell you, but the ones which I've seen is usually 2 million and above. Then you enter the amount. That is if you're dealing with non-competitive. The yield is fixed. For competitive, it is you to set that. But remember, you won't be guaranteed. It depends. Then make sure you submit before deadline. You have not paid anything. You have just submitted your bid. It's like when you go to a shop, you want to buy something. You tell a shopkeeper, and by the way, I want that bread. It's 15, they tell you it's 100. You say, I'll come and pay. If you agree with me, I get the bread. So you go home, then the shopkeeper one day sends you a message and tells you, by the way, you have qualified for this bread, come for it. That time you pay. It's the same thing. You place a bid, you have not paid. You have shown interest in that board. More people will come and do it, place their bid. Then at the auction date, the government will first check, is it oversubscribed? If it is, then they will decide how the allocations will be. If it is not, then everybody gets. And that's where now for competitive bidding, you need to be very careful. First of all, they give those who have given. Sorry, for competitive bidding, you have to be careful. First of all, they allocate to non-competitive because you have agreed to their rate. Then they come to the competitive. They check. Those who qualify, now they are routed. Once now auction results are released, you know whether you have been allocated or not. You get a message or an email. If you are successful, then proceed to payment. You don't have to do it. Remember, you gave your bank account. If it is funded, money will automatically be deducted from your bank account. However, always check instructions, because if they find there is no money in your bank, in your account, then you may be required to make the payment the same day. But make sure the bank account is fully funded. The one you have given, and it's the one you are using for payment. Immediately that payment is received, the board reflects in your account, and you can see it in your CDS, your CBK Do CSD app or portal. You won't see it in the broker. Broker only deals with shares, but very soon AIB Access now will start trading on boards, which you'll be able now to see on our Digit Trader, and you'll be able to see performance of your board on daily together with the shares, but they will have their own section. Don't be tempted to sell, because there is I know you, when you go there you seek a small profit and you want to sell. That time, as I told you, this channel is not affiliated to any broker. I'll be telling you openly why you should not sell. The prices you see there, they are commissions to pay. Broker have to make money. So when you get it on a digital platform, don't be tempted. Otherwise, you end up missing an investment that would have given you good returns in future. So once the board reflects on your accounts in CBK, you are now a board holder entitled to the coupon payment every 6 months. It is you to make the decision to hold to maturity, or you can sell in between in secondary market. So you have two types of competitive bidding. So bidding is where now you are doing directly from Do CSD platform for the boards which have been opened, new ones or reopened, the ones which have maybe already matured, but they were reopened again. So there are two types, non-competitive and competitive. We have seen it on that image that I've just shown you for the two boards. Now, non-competitive, this is the simplest way to bid a board. You only enter the amount and accept the market rate. That is the yield. The price. Yield is the price you are buying at. If most of it, the base rate is usually 100. That's why you see most of the boards in the NSE price list is 100 point something. That is the price. 100 is the base. Anything point something, that is now the price you are selling at, the profit. Either if it is above 100, you may be selling at a profit. If it is lower, maybe it is 90 point something, it means the prices have gone down. So you accept that you are taking the market rate. Here you are guaranteed allocations within your limits. It is simple. Now you are not choosing any interest rates, and it is good for beginners because you are not hustling to do some mathematics. However, now for competitive bidding, it is a bit advanced. Yes, you enter the amount same as non-competitive, but you also enter your desired yield. That is the interest rate. So the allocation will depend on your bid against the market. You may either get full allocation, especially when the board is not fully is not oversubscribed or it's not fully subscribed. You may also get partial allocation or no allocation if your bid is way outside the market rates, and maybe between them there is better rates for the government. Remember, even government wants also to save money. So for this one, it gives you more control because it is you dictating, not the market rates, and you can get better returns. When we say returns in the board, we always think it is the interest. No, it is. It also includes the price you are paying at. We'll come to that. You may also miss, because then if you give your bids are way outside, that is your yield is way outside the rate the government would want to take, then it means you won't get any allocation. So non-competitive, you accept whatever you get in the market rates. Competitive, it is you to choose your rate and compete with others. We come to coupon versus yield. The difference between the two is, one is what you see and the other one is what you earn. I know this will confuse some of us who have been investing. So coupon is what you see. You have been told this is the interest rate that you'll be earning. But is it what you actually earn? Remember, there is a price you are paying, especially if you are buying from secondary market. This affects those who buy directly from the market. If you're bidding from primary, then you don't need to worry, because that coupon is fixed. If you are told you'll be getting 12%, that's what you'll be getting. And it is based on face value. If it is 50,000 times the coupon, if it is 12%, that's what you'll be getting, because now it's 1 year times 1 divided by 2. It doesn't change for the duration of that bond. Take a good example of 12.5% coupon, like the one we have seen, the one that was opened this year. If you're bidding 50,000 and you get allotted, it means every year you're getting 6,250. It will be same for everyone holding that bond. The coupon doesn't change, the 12.5. What matters is the amount that you put in. If all of you invested 50,000, it means you're getting the same amount, 6,250. If somebody invested 100,000, then they get 12,500. Like that. So it is same for the same amount. The returns are the same and fixed for the entire duration. What about the yield? That's what you actually earn from the market. It is your real return. It depends on the price you buy bond at. In primary, you're actually buying at 50,000. It is fixed, 100,000, 1 million. However, in secondary market, the price changes depending on some factors that affect the pricing. We will come to that. So the yield, remember, if I'm buying a bond of 50,000, that is, at maturity, I'll get 50,000. I might buy this bond at 48,000 in the market. I already have my 2,000. Remember, I'll get 50,000. I've paid 48 through the broker. So there is a 2,000 profit. Buying low, I'll get full amount on maturity. On top of that, I'm also getting my coupon of 12.5. What does that mean? Your real returns on the board depends on the yield, not the coupon. Because there is that price difference. Remember, if you're buying from primary, it is 12.5% your interest coupon plus the difference between what you are paying now against what you receive at maturity. You pay 50,000, receive 50,000. So the net is 0. So basically your yield for buying bond on primary is there your coupon. What about buying in secondary market? You buy cheaper, it means you add that return to your coupon. That gives you the yield, which is now your actual returns for holding that bond, which could be higher or lower depending on factors. This yield is different for each investor. Why? We are not buying the bond at the same price. I could be buying the bond for 48,000, but you get another broker who gives you even a good rate. You buy it at 40. There is a total difference. We are buying the same bond, but different prices because they are dependent on the broker. Remember, broker adds their commission, markup, that is the profit, and also their revenues. And also the person whom you are buying from also have to get either a profit, or if they are selling at a loss, there is how far they can go lower. So it's always different for each investor. And this is what you should be looking for. This you have to do some mathematics. You have your coupon, you already know it. Then check the price you're buying at and what you get. You have, of course, if it's 100,000, that's what you get at maturity, but you might be buying higher or lower. You need to get that difference. Add it to your coupon. That gives you the real returns for the board. I've said for primary market, you get the coupon as the yield because there is no difference between the amount you put now and the amount you get later when the board matures. If it is 50, the amount you are putting now, you get back 50. Difference 0, meaning your yield is equals coupon. When you're buying in the market, you get a full the face value if it is 100,000, but you may be paying that board 90,000. There is a difference. You have discount of 10,000. You only need to get that percentage added to your coupon. That is your real return for holding that board. Why am I saying this? You'll be comparing this between buying a board from the market directly through a broker against bidding in primary market. So let's take a same example, same board, 12.5 coupon. That is your interest that will be paid annually. Assuming you get this board at a discount, you buy it at 48,000. You are buying it at a discount. Why? You will pay 48,000. This amount, maybe it is inclusive of all charges. So you pay 48,000 through the broker. Broker will tell you the amount you pay directly to CBK and their commission. But assuming the total comes to 48. At maturity of that board, you get 50,000. There is a difference of 2,000. Remember, your coupon will still be paid every 6 months. For a year, same board 50,000, you get your 6,250. Then at maturity, you are getting back as 50,000, not 48. You have gained another 2,000. You need to add that in your coupon to get the returns. These returns are what we are calling yield. So your return may be higher. Now take the same board, 50,000, but inclusive of cost and everything else, you buy at 52 at premium. So you are paying more. You still earn the same interest, 6,250 per year. That doesn't change for the duration of the bond. But remember, you're losing 2,000. Why? You pay 52,000, you get back 50,000 on maturity. So again, you lower your returns. Your returns are lower than the 12.5 coupon. So that's why when buying a bond through a broker, you need to get the yield. Always tell the broker, yield to maturity. It's called the YTM. What is my return on maturity? Always ask for that, so that it is not lower than the coupon. Because again, it means you are buying a board expensive, get the same returns as if you would have bought it in primary, but end up paying higher amount. Because you pay higher, get lower amount at maturity. Hope that is clear. Now compare that with bidding the same 50,000 in primaries. You still earn your 6,250 per year. And at maturity, you get back your board as it was 50,000. So your return equals coupon. That's why in primaries, your yield equals your coupon. That percentage you see there. Buying in the market, always calculate at the price you are getting the board at. We'll be doing this practically next week, using now the sample of the boards which are trading, so that now you understand these in details for those who are new in boards. So the simple way here is coupon is what board pays you, but then yield is what you actually earn. Because remember, there is a price to that board. So during primaries, you focus on coupon. If you are applying directly through CBK, check the coupon. You don't need to calculate anything. Coupon, percentage. Am I willing to get those returns? Secondary market, you focus on yield, which is your coupon plus the difference in price. There is amount you get back. If it is 1 million board, you get your million back. But how much do you pay in primary market? In secondary market, you could be buying it maybe at 900,000. That is even way cheaper. You could be paying 1,200,000. It means you are paying higher. But remember, now the difference here is, why would you want to go then for a board in primary market, in secondary market, where in primary market you can get good rates? It's all about the duration. Maybe the board in a secondary market, you hold it maybe for the next 5 years, you get your money back. You see, it's better to go directly to secondary market rather than buy a board which you hold for that another 30 years. So those are things you also check before you buy a board. And that brings us to primary and secondary market. I've talked about primary and secondary market. Let me take one question. Sorry, I really don't understand it when you say secondary market. That's where we are in that screen. All the terminologies, as we go on, all the terminologies are putting in, they are simplified. There is a question, where would you buy at 48 and get 50 on maturity? You are buying directly from the broker, not from the government. Once the board is listed at CBK, after the government have closed, if you want your money back, you can always sell to another person in secondary market. That means you're going to a broker to source for you somebody to buy that board. When you come to me, it's a board of 50,000. I might decide, so you want to get out of that board, I will buy at a discount. I tell you I want that board at around, let's say 47,000. The broker will do some mathematics, add the commission, they tell you this board is worth 48,000. Remember, if you held at maturity, you get your 50,000. Since you need your money and maybe it is urgent, you will decide to sell it at 48. I, as Peter, who is buying, I'll buy it now at 48. But remember, at maturity, I'll get my board intact, 50,000. What you are supposed to get at maturity, because that is the face value of that board. So when you are buying from the broker directly, you may buy cheaper or higher. If you look at the right side where how price affects return, option A and option B is where you are buying from a broker. That is secondary market. Option C, where you're bidding primary, is where you're buying directly from CBK. It's called primaries. So that is the difference. A, where you're buying either at a discount. B, where you're buying at premium. That is through a broker or a board dealer. Because right now CMA have allowed board dealers who are not brokers, but they are allowed to trade in boards. Because boards, you don't actually need a broker. You pay directly through CBK. You only pay commission to the broker. So that's why they have allowed board dealers. You might start seeing even applications coming out where you can trade boards. I know that with a short time you start seeing that. A and B is where you're buying through a broker or a board dealer. That is secondary market. Option C is primaries, where it is the first time the board, or it is the first time the board is floated, or the government have decided to reopen an existing board for the duration that is remaining, or it is a closed board they want to reopen. Maybe they don't want to reissue another board. That time it is primaries, where you are buying directly from CBK. You are paying full amount to the CBK without any charges. So that's where now primary and secondary markets comes in. And that's where now the difference between 48 and 50 comes in. I hope now it is clear. Would this be from someone who wants to sell and you negotiate? Ideally, yes. What a broker is doing is negotiating price on your behalf if you are buying, and also a price on behalf of a seller. In agreement, the board changes hands. You mentioned board performance when discussing the feature of the app. You also said board returns is fixed at the beginning. Shouldn't the performance also be fixed? No, there is a difference. Board returns which are fixed is the coupon. If you're buying from primary, that does not change anywhere. If you don't sell that board up to maturity, your returns are fixed. It's 12.5 or whichever coupon rate they have given you. It doesn't change because at the end of the board, you're getting back the 50,000. You get 50, you're getting 50. There is zero return in terms of the face value. What changes is what you are getting in between is the coupons, the interest. However, when you buy in the market, this is where the difference comes in. The coupon does not change. When the person sells to you, you continue earning the coupon for the remaining duration. Every 6 months, it is you now who will be getting the 12.5. That is fixed. It doesn't change. But remember, you may be buying this board at a cheaper price. Peter paid 50. He's selling to you at 48. So you, instead of paying 50 to CBK, you are paying 48 to Peter to exchange what he paid 50. So you are buying at a discount. What will you get at the end? What Peter was supposed to get 50. So 48 minus 50, you have a discount of 2,000. You need it to add it to your returns, which is you add to your coupon, which is yield. What do you get? Remember, for primaries, there is no difference between what you pay now and what you get in maturity. The difference comes in when you're buying from secondary market. Because the same board of 50, I could be buying at 52,000. I'll get back 50. There is a difference. I'm overpaying by 2,000 because I paid Peter 52. But Peter paid what in primaries? 50. And that's what I'll get back. So I've lost 2,000. So my returns at the end is not even 12.5. That 12.5, I've even paid another 2,000. It might be lower. So that's why performance of the board during the duration matters, where you are buying from. If you are buying from CBK directly, nothing changes. Your return at the end, the yield remains as coupon. If you are buying from the market, it could be higher or lower depending on the price you buy at. I saw that some are offering a fixed income fund from as low as 2,500. How could you classify these? Now, this is why I said there is something called omnibus account. Sanlam already they have opened a CBK account. They invest in bonds. So what they are telling us, give us your money from as little as 2,500. We combine this money as one figure, go buy a bond in the market, invest on your behalf as a ransom. Then we'll be giving you some returns. That's what is called fixed income fund. It is a fund where it's like money market fund or special funds where you're depositing your money, but instead of investing in any other product, they buy bonds, either government bonds or corporate bonds or bonds that's trade from outside the country. So this one specifically, it's them who are investing as a lump sum using their account. The difference between you and them is that they don't pay commissions. They don't pay commissions. So the amount they get is what they use to buy the bond. Once they buy that bond, the returns they are getting now, coupon plus now the difference in the price gives them the yield. That yield determines the interest rate they'll give you for the fund. I hope it is clear, Edwin. Let's continue. So we come now to the terms I've used, primary and secondary market. The difference is buying from CBK, primary, secondary, buying through a broker. So primary market is usually CBK auction. A board have been reopened or it is a new board. So you are paying directly to CBK. You are buying that board from CBK. You are loaning that money to CBK. You are actually loaning money to the government. This could be a board or a T-bill, which is issued the first time or reopened, and you apply directly from DO CSD platform. You go to that bill or a board, you bid either competitive or non-competitive. You have seen that. Submit your application, make sure your bank is funded. Once you pay that board, you become a board holder. You have not paid any extra fee. You pay directly to CBK. Analogy here, when you are buying shares at NSE during IPO, where you are giving money directly to the company, like KPC IPO, we pay directly to KPC. We didn't pay the broker. So that is the same analogy here. You are paying money directly to the government through CBK. Price and yield, they are always determined after auction. Everything is always clear. You already know the duration you are holding that bond. We have seen that prospectus, everything is there. And you're only limited to the board that have either been floated or reopened. You don't have a choice that you want this board or not. It's what they are floated. Now, secondary market. This is where you buy a board from another investor. Peter wants to sell what he got through the primary. He wants to sell to somebody. You have told the broker, look for me somebody to buy. Then you want to buy. You and me and you, we are not getting money from CBK. You have not received my money from CBK at all. You are not paying CBK. You are paying me to exchange the board with you. So what I bought, let's say at 50,000, I come and tell you, give me 48. I'm willing to take that. You take the board, continue with it. Or I'm selling at 52. Are you willing? Give me. You take the board and continue with it. I get the money. I get out. So you are buying an existing board which have been bought by another investor in primary market. That is done through a broker or a board dealer. It doesn't involve CBK. Only that now payment is where CBK comes in. Because you as the buyer, you have to pay money directly to CBK for CBK to pay the seller. Then CBK will move the board from the CBK CDS account of the seller to your CBK account. So that's where CBK comes in terms of settlement. The same thing at CDS, where you have to pay a broker, broker pays CDSE, CDSE moves shares and pays the person who have sold. It's the same analogy here, but it's going through a broker. The difference is primary, no broker. Secondary, there is a broker with additional charges because of brokerage and levies. Primary is nothing. You don't pay anything. Only bank transfer charges or M-Pesa if they are around. In secondary market, price is quoted and negotiated on due time. It is a broker who gives you the price. They tell you this is the price of the board. Do you want it or not? You negotiate. Primaries, remember you can't negotiate. And in secondary market, you can buy anytime as long as CBK timelines are observed. You don't wait for a duration that you bid today, you wait until allocation. No. The same day you are buying, you pay for that board through a broker and you are allotted if it goes through. And here you have choice of mini bonds, the ones which are trading. With different maturities, different coupons, you can calculate the yield and get different. But remember, for yield, it is based on the price from the broker. Now, when we go digital, you will have a price there. Now I will show you how to calculate that price next week to see the yield, the returns you get on that board. We use existing boards in NSE and do those calculations so that you're able to calculate. AIB have shown me a board, I can buy it, let's say 100.52. But in the market, I have the board which I'll pay at 100, that's the face value. So there is a difference in terms of price between buying from AIB and primary, but the two boards are giving me the same returns. So you only make decision. How much commission am I paying on this board? Add on it. Now get the profit you will get from buying this board from the market. Maybe you are paying cheaper than the amount you get back. Add that to the coupon. That tells you the return. You only need to compare that yield against coupon in primary market. Also, check the duration of the board. The one in the primary could be holding your money for 30 years. Maybe these are the one is 10 or less years. Remember, interest doesn't change. So where does the opportunity lie? Remember, in shares, we have always said opportunities are there. Buy low, sell high. That is the song we have been singing until Peter came in and said there is dividends. Invest long term and dividend, add together from selling high. Now in dividends, where do opportunities lie? Primary market, where you're buying directly from CBK. First of all, it is simple in beginner friendly. You're only putting amount you want, submit, you wait. It's only good when the coupons are attractive. That is, the interest you're getting is more attractive than another board. Also, in non-competitive bidding, where you are guaranteed full allocation. So for primaries, always go for non-competitive, you get full allocation. It doesn't change anything if you go for non-competitive, because when you go for competitive, first of all, it requires high minimums, and you may not be guaranteed. Now come to secondary market, where you are buying through a broker. Here you might get lower prices. I've said a board that you'll get maybe 100,000. You may be buying at 80,000 from another person. Already there is 20,000. Plus the interest doesn't change that you are be earning for the remaining duration. So here you are buying at a discount and maintain the same coupon payment. Meaning what? Here you have higher yields compared to primary, because in primary yield it equals your coupon, because there is no price difference. And more flexibility in choosing maturity. It is you with choosing the board that you want. If you want a board that is remaining with 5 years, you get. One remaining in 2 years, you get. One remaining with 15 years, you get. So for primaries, simple structure, it is structured, but you have limited options because it's the one board and you can only choose between competitive and non-competitive, which we have seen the effect. Secondary market, flexibility, more options, many boards to choose from, better pricing, but always check commissions they eat into your returns. So for secondary market, there are opportunities if you get a genuine broker who is telling you the returns, that is your yield. Always ask that from a broker, your yield. Compare it with primary market coupon. There is something you find in boards which confuses most people. There are two prices you get in the boards. There is dirty price and clean price. We'll go through all these next week. I wanted to go through the theory so that when you are doing practicals, you have everything. Clean price is what you see. This is the quoted price of the board. You will actually see it on from the broker. They will give you that. This does not include interest that have been earned so far. Remember, there is the interest which have been accrued by the person who is selling to you. Hopefully, I have not been dropped. Just confirm. You can still hear me. You can still hear me. Okay, because there was a power fluctuation in the office. So clean price is the quoted price of the board. This does not include the interest earned so far. This is only used for comparison in the market. That is comparing boards. And when you ask a broker, this is the price they usually first give you, the dirty price. It doesn't even include commissions at all or anything. So when you ask a broker, when they tell you the board is going at this price, ask them, is this the clean price or the dirty price? Now there is the dirty price. I don't know why they decided to use these two terms. When I ran the boards, I first thought, you know, the word dirty, what it means. I tried to imagine what can be dirty in that. But then when you interpret it in layman, it tells you this is a price that includes other things you do not want to hear. if you are to buy in the primary market. It includes the accrued interest plus the broker commissions and everything. So this is the total price you pay. So that a price, the actual price you pay. It will include now the clean price, what the broker tells you the first time, plus accrued interest. What is this interest? Let's take a scenario where the board, the last payment was in January, for argument's sake. When you are buying from the person who is selling to you, they were paid the last interest in January. Between January and April, they are still earning interest, which is supposed to be paid maybe in June. Who is supposed to pay that interest? Remember, when I buy that boat from them, the interest will come to me, not them. How do they get their interest? That's why it is factored in the date price, because you have to pay them the interest for the duration they have held before the next board. I hope I have not confused you. So you get the clean price. That is, if I was to pay the date the board is paying interest, this is the price I would have paid. But then somebody is selling in between before the next payment. Remember, the next board, once I buy the boat today, it is me who will be paid, not the person who had the board. Who will pay them that interest for January to date? It is me who is supposed to pay them. So I pay upfront. So when I'm paying for that board, the correct price in the market, clean price, I need to add the interest earned from January to date, the time I'm buying, so that I pay them. So that is what is called real cost of buying the board in the market. So always factor that when you're buying. Then why would these interest be charged on you? Remember, board interest is fixed. If you buy the board in between, the previous owner, yes, they have earned interest up to that time. That is part of the interest that you will get. You need to compensate them, because CBK will pay you as the new board holder, not them. It's the same thing in shares. When you buy a share that have declared dividend, you are buying from somebody. When they sell to you, they no longer become a shareholder. They are not the one who will be paid dividend, it is you. But now for dividend, you don't pay them. So they have decided to sell. Now for board, it is different. They have been holding that board. They didn't go to government and tell them, we'll give back my money. They have held up to that duration. They have earned it part of your interest. So you have to pay them. That's why it is included in the date price. So a simple example, but we'll be doing these calculations next week. Let's say board face value is 50,000. That's what the original owner paid to the government. Coupon 6,000 every year. So every 6 months, the original owner was getting 3,000. January they got their 3,000. So in June they are supposed to get 3,000, but in between they have decided to sell. So if I'm buying in between, me I'll get the 3,000. That's what government will pay me. But remember, the seller had already earned 1,500 from January to date. The remaining 3 months, it's me who is supposed to earn, because I've bought the board in between. So when I'm buying that board, I have to pay the 1,500 back to the old owner. That 1,500 is added to the clean price, 50,000, to give me now the new data price, which is 51,500, because I have to pay them the interest, part of the interest. However, in NSE price list, you won't see 51,500. The board face value is usually given 100. So you only need to factor the difference. 50,000. Ideally, it is 100 divided by 50,000 times 51,500. Now you get it in terms of now what you see in NSC prices. We'll be going through all this. I don't want to go it through now. because it might confuse you. But now you understand. Clean price is what was paid by the original owner, the amount that was given to the government, 50,000. Dirty price is now what I'm buying at, inclusive of the interest I'm supposed to pay to the original owner for the duration they have held the board from the last time they got the interest. Remember, they have earned up to that duration. So a simple way to understand this: clean price, board price, the amount that was paid to the government. Dirty price is now what was paid to the government plus the interest the board holder have earned for the duration they have held the board since the last time they got the interest, because they are the ones who are supposed to get the next interest, but they have decided to say to me, I'm the one who get the whole interest. I'm supposed to pay part of it back to them. And that's why I said, even if it is the same board, person who bought from primary market, the ones who are buying in secondary market, everything will always be different apart from coupon. Returns will be different because there are those who will be paying more, there are those who will be paying less, depending on the price of the board. So the price quoted by the broker the first time you ask them, it's not what you pay. The actual price is the price quoted by the broker plus accrued interest. Always ask the broker, is this clean price or dirty price? Otherwise, you find, and it is a art brokers have perfected. That's why I said all these trainings I can't do as AIB or any broker. They will always tell you the clean price. You think, hey, you are paying good money. Once you pay, that's when now you find them sending you another email. You are supposed to pay commissions. So always ask, is it clean price or dirty price? If it is clean price, ask them the dirty price because it factors the accrued interest. Also in that dirty price, ask them, have you included commissions and levies? So pricing and market dynamics. First of all, in shares, we know the price moves because of demand and supply. Purely demand and supply. What affects demand? What affects supply? What about boards? Boards moves because of two things: interest rates and demand of that board. So we start with the interest rates because this is something most of us forget when we want to buy or sell the board in the secondary market through a broker. We forget to check interest rates. So the way interest rates affect the board price is when interest rates go up, board prices go down. Why? Remember, when the interest rates goes up, if you don't want to invest in boards, you want to go to money market fund. You want to go to fixed deposits. Board demand goes down. What does that mean? If people want to sell, then they have to lower their prices. I hope that is clear. Interest rates, they go up. What becomes favorable at that point? Money market fund, fixed deposits in the bank, you find they become favorable. So most people, they run now to money market fund and fixed deposits. There is no demand for boards. The sellers, they are forced to lower the prices. When interest rates go down, board prices go up. Why? When interest rates go down, remember, boards coupon don't change. They still become attractive. What does that mean? You all want to buy boards. The people who hold the boards, they want to sell at a high price. Price goes up. That is a simple explanation. Interest rates going up, people want to rush to other products. Sellers are forced to sell at low price. Interest rates go down, those products, they become unfavorable. You want the boards because they still have good coupons. When you come now to boards, it means you are pushing the prices up. Hope that is clear. Just confirm you can still hear me. Confirm you can still hear me? Okay. And I hope now it's becoming clear why interest rates affect both prices. So whenever you see government or there is announcement by CBK, interest rates may go up. That is the time now to look for secondary boards. See, they have said maybe in the next 6 months interest rates, or there is some speculation interest rates will go up. That time now it is time to look for secondary boards. Why? Because the prices have gone down. That time you want to get in, because as others run to those products, you are able to buy that board at a lower price. If there is anticipation interest rates will go down, as people come to buy those boards, money market fund and the others, that time they are affected. You as a strategic investor, you want to go there. You don't want to go with them because boards prices go up. If you still want to invest in boards, this is the time to go for primary boards. So when you expect interest rates to go down, always check primary boards, their rates. If interest rates are going up, now you compare secondary market against primary market. If boards are not attractive, that is the time you go for other products. So basically, the price, as I've said, it's because investors will try to compare even new boards and old boards. You find a new board may not be attractive at some point. You prefer even old boards. So like now, a board comes in with a higher coupon. Would you want to buy an old board that has a lower coupon? No, you'd want to go for this new. So it means the people who hold these boards will also be forced to lower the prices to compete now with the new boards. It is you now to make decision. What is your yield? I've said what is the yield. For new board in primary equals coupon. If you're buying from secondary market, you add the interest you are paying for the remaining duration plus commissions. You get your returns. Then compare the two. Then the other thing that affects board prices is market demand. When there is high demand in boards, of course, prices will go up because the sellers again now want to hold on to those boards. If there is low demand, then prices go down. Then also time to maturity. We said when you buy a board, you are subjected to maturity unless you decide to sell in between. As a board maturity nears, the price may move closer to the face value of the board. It means if let's say the board price was around 40, it may move closer because the person who is holding that board, they may decide I won't sell because I want this money. Then those who want to buy, they may push those prices up. So the time to maturity also matters, but in NSC, it doesn't affect prices much than interest rates and market demand. Then we said when we are in this presentation, there is the discount where you are paying less and there is premium where you are paying more for the same board in secondary market. So we come and understand those terminologies. So discount is where you are paying at a cheaper price. So you buy below the face value. If let's say the face value is 50,000, you are paying 48,000. You still receive your full interest for the remaining duration, and at maturity you get full amount. So apart from getting the interest that is remaining, there is that discount you bought at. So in terms of yield, it is higher. There is higher returns because there is a coupon plus the discount you bought at. So for discount, boards, you have a good buying opportunity. Then premium. This is why you are paying a higher price. Face value is 50,000, but you are buying that in secondary market at 52. You still earn the same interest for the remaining duration, but then you are losing because you paid 52, you receive 50. So your yield or your returns will drop. And this may happen when there is high demand of the boards. So always check whether it is the season for boards. When there is high demand, you may end up paying higher. And as I said, a broker will never tell you. It is you to do those calculations. You already know how much am I expecting as the return, how much am I paying. If you are paying higher than what you will get, then that board you are buying at premium. Never show a broker you are desperate to buy a board because they look for the most expensive because you will not know. But through their mathematics, you see like you're getting good returns. Always ask, what is my yield to maturity, YTM? Simple way to understand this, discount you buy raw, you get higher returns because you get full amount plus the remaining interest. Premium, you are buying high, so your returns go low. So we come to one of the boards that I've seen have been introduced, but it has been there, only that it's not that frequent. It's called switch auction. Remember, you have auction in the primaries where government floats a new board or reopens a new board. You apply. Now, what is a switch auction? This is where you exchange one board for another. As the word says, switch. You are moving from one board to another. This is done through CBK. And how does it happen? A board, maybe it was 30 years, it has matured 2026. Government is supposed to pay you money back. If government doesn't have money, what is it supposed to do? Ideally, when you have a loan and you don't have money to pay, you default. So government, instead of defaulting, they decide, instead of paying Peter his money, why not give him an opportunity? Even if we can pay him, why not give him an opportunity? He can take another board that would extend that loan for some time. So ideally, I will not get my money back. No cash is paid out, but now you move to a new board. So my whole investment will move to another new board. And I continue now for the rest duration. So if it is another 10 years, I will hold my money 10 years, hold that board. I have not been subjected to primaries where I need to bid for a new board. I have not been subjected to secondary market where I buy a new board. The government is just giving me an opportunity, move to a new board. If you want your money back, they will give you. If you don't want, you want to continue. So when is it favorable for you? One, when your current board is nearing maturity and you don't want your principal back. Instead of receiving that board, you can move to a new board that has been floated by the government. They will say, I think there is one which they did. It's only that I didn't manage to get that extract. It is not you as the investor who goes and tell them you want a switch board. It's government to say, this board you are currently holding, there is a switch auction. Do you want? So it's not you to decide. Huh? Also, it's good when you want a longer investment period. Instead of getting your money back, you still want that money to continue there earning interest. Huh? And when the new board offers good returns, so you want to lock in more attractive yield. Remember, the only thing you'd have done, get your money back, bid for another one, which you get maybe a lower coupon, or you buy from secondary market, which may reduce your yield. So basically, you want to extend investment duration, lock in maybe longer returns, and avoid reinvestment risk because you would have to look for a new investment when you receive your money back. Either new primary, or you buy from secondary, or move to another product. So the key idea here, instead of getting your money back, it continues earning interest. And again, you don't push the government to look for that money because government would need maybe to float another boat to pay these. And you know what that means. If they look for another board, they have to pay. Ideally, it moves to taxes. Or you move into a new board with a new maturity along a period. So a good example, a board is in 2026, government says there is a switch auction, you decide now to bid for it. So the board that is maturing gets into another investment which maybe extends to 2056. So you continue earning without receiving your money back. So we come to the last slides, but all these we'll do now practically because we have done theory. We'll do this practically next week. How then do you choose the right board? It's not just getting into auction or primaries or going to a broker and selecting they give you a board and you decide to invest. You need to understand. First of all, focus on yield, duration, and timing. Very important. Focus on yield, duration, and timing. The broker here doesn't care about the duration. The longer the board, the better. The longer the duration, because it will look attractive to you. Timing is very important. Market conditions. The broker here will not advise you whether the interest rates are going up or yield. No broker will tell you your returns. Them they will actually like when you concentrate on coupon interest. That's something they will even insist. Your interest is 12.5. Give the 50,000. Give us 52,000. You get a board for 50,000. It is available. You give quickly, but remember you're paying 52,000 to receive 50. You have lost 2,000. Remove it from your coupon. You realize it might even go lower, maybe to 10 or 11%. That is your return. If you get a genuine broker, he will tell you, pay this at 48, you get 50,000. You have gained 2,000. You still get your returns 12%. If you add, maybe comes to 13%. That's what is called yield. Your real return. When you're buying from primary market directly from CBK during auction, when the board is floated the first time or is reopened, your real return equals the coupon, because there is no difference between what you pay and what you receive. If you are buying from the broker, that's where the difference comes in. You still get your interest, but the price may change. You may be paying higher or lower. You need to factor that now to know your new return, which is called yield. So never just look at the coupon when you're buying boards. Hopefully I'm not giving you too much. But we have our group, the group on WhatsApp, where we discuss all these. If you have not joined, just reach out. That link is usually, it's free. I've never charged anyone to join. If you want to buy soda, it's always free. On that WhatsApp number is my in-person number. You can always buy whatever you want, whatever little. Don't stress yourself. You are here to make money. Peter alijitolea to do all these. So don't just look at the coupon. Check what you actually earn based on the price you are buying. I've said in primary, price you pay is price you get back. So there is no difference. That's why your yield, your return equals your coupon. When you're buying from the broker, the price you buy at is different. The price you get back is the face value of that board. Always factor that out. It means when you buy at a lower price, your yields will be higher, better returns, because you're still getting the same coupon plus the discount. You pay less, you get higher amount. This is very important when you're buying from secondary market. But what did we say? Before you even buy in primary market, always compare. Before you even buy from secondary market, always compare the two, which gives you good returns. Then duration matters a lot. The time to maturity. If you're buying from secondary market, the board is 12%, maybe all of them. and one have a short of 5 and another one 15, and in primary you have 30, and you find holding this board for 5 years may be shorter, but then your yield is lower. Why would you want to go for that board? Whereas still you can buy that board of 15 or 30 years and your returns are higher. So I always check how long will your money be locked into that board. Remember, duration is the duration your money is locked, and underline the word locked. You cannot get that money from the government until maturity unless you sell to somebody else. So for short term, that is when duration is short, it is more flexible because you get your money back quickly. So if you're going for secondary market and you need your money back quickly, always look for the remaining duration for the shortest period, or you go for T-bills. If you're willing to lock your money for the longest, remember now returns will be steady for many years. So if you don't need your money quickly, never go for long-term bonds. We saw it in Safaricom and EABL board where people are bought, you want your money quickly. In boards, never do that. You may end up losing. Huh? So always choose duration based on when you need your money back. Then timing, market conditions. Interest rates are very important when you're buying boards. If interests are very high, buy a long-term board. It is favorable by that point. Huh? If interest rates are rising, then that time go to a broker. You may get a better rate because the prices will go down. You buy at discount. So if interest rates in the market are going up, and I'm not talking about coupon. Coupon doesn't change. It is general market interest rates that are paid out. If they are rising, that time you can get a board with better prices. Because one, people may decide to go to other products or buy new boards, meaning the existing ones, prices will go down. If interest rates are falling, it means the new board, because the coupon will be higher, if interest rates are falling, remember now, the existing boards may become favorable. So even timing, the market conditions, we'll do all these practically next week. Hopefully I can get a scenario where we can play around with the interest rates. We see how they actually affect bonds. Because when they are going up, you can buy at a lower price. Huh? If rates are falling, then existing bonds, it means their coupon, they are still fixed. And instead of going to the product where rates are lower, it's better to buy from the market. Huh? Then also matching your board to your goal. Everybody has a goal, even in when you're investing in NSE. If you're looking for income, that is stable interest, always go for boards with stable coupon, because the income you're getting is through interest. You still get your money back, but income comes from where? The interest. That is a board with a regular cash flow, and if possible, better coupon. If you're looking for capital preservation, always focus on safety. That is, even the price that you are paying, is it cheaper? If it is cheaper, the better. If it is higher, go for primary, because primary you get back the full amount. And remember to hold to maturity to get your full amount. If you're looking for higher returns, we have said returns is not coupon. It's coupon price, the discounts you get. Always look for boards that are trading at discount. Always ask your broker for a higher yield. Don't just rush in for high coupons. If you are investing for liquidity needs, that is when you invest, you need your money in the shortest period. Always ask yourself, will you need this money soon? If yes, go for short-term T-bills or boards with the remaining short period. If no, then go for better boards that have a long term. So basically, when you need money soon, T-bills, boards with a short term remaining. If you want income, longer term boards with high coupon. If you want higher returns, then you are looking for discount in secondary market and also compare the coupon. So this one I don't want us to go today because of time. Let's go to common. This we'll do with comparison of the boards so that I'm able to explain to you what even FXD means, is DB, IFB. So if you see a board with IFB, that is infrastructure board, the rest are not infrastructure boards. We'll go through that because I have to explain those terminologies. Then we do coupon, maturity, payment structure, how you get the interest in real practical session. What you earn using real numbers, your yield, how you calculate it, because that's what now will help you compare buying from primary, buying from secondary, switch auction, and the others. So that time you'll be able to identify coupon, tenor of the board, issue and maturity, and auction dates and deadlines. And that time, for the first time, we do some exam kidogo. We see kama we usually Kwetha Peter usually explain these things in a layman. Kutakuwa na ka exam kidogo, you just be getting pop-up, you click, we see how we are faring. So let's go to common mistakes to avoid. Never focus on coupon only. You may be missing other opportunities. So high interest for coupon doesn't always mean you are getting better returns. You could be having other boards, or even if you are buying from secondary market, you could be overpaying. Ignoring the yield. Yield is the most important. It is a real returns. Then locking your money for the long term. At one point, if you need the money, you'll be forced to sell, maybe sell at a loss. Always factor that out. And pricing. Data price, screen price, broker commission levies needs to be included so that you know your real returns. So if you're buying board at a premium, at a higher price, you're actually reducing your returns. And investing without a plan. You have heard people want to invest in the boards, you want to go there. Interest rates have moved, you want to move to boards. Always have a strategy. Even in shares, always have a strategy. That's my WhatsApp number. Community is my wealth guide, KE. We come to questions. There are those that I had covered. Let's say I buy from secondary in March, where board opened in January. What interest do I get at half the year? You as the new board holder, you get the full amount interest. But at the time you are buying, the existing board holder will factor out the board you are supposed to pay for the duration they have held from January to the time you are buying. So whatever price they will give you is the data price. The clean price of the board plus the interest you are supposed to pay them. So you get, at the end of it, you get the six month interest, but remember the price you are paying to the board holder is not the 50,000. You may pay 53,000, but out of that 53, there is the interest. But in March, let's say in June, you get the full interest. But remember, when you are paying them to buy that board, you have already paid part of the interest. Hope that is clear. I thought there is no interest earned on the board interest. Interest as in? Maybe I don't get you. Meaning, even if you don't cash out, one does not get any extra interest unless it is compound interest. No. For boards, I'm not sure where I said this. For boards, there is that coupon, that is the interest. That does not change at all. It is fixed. Now, the difference is when you're buying from secondary market through a broker. If you're buying from primary, coupon doesn't change. Now, come to the broker. The interest still doesn't change. When you buy, you continue getting that interest the original holder was getting. But remember, at the point you are buying, the original holder could have earned interest if they held for 6 months. You have to pay them back. Also, there are commissions you are paying. So basically, when you're buying in secondary market, you have to check the price you're buying at. If it is cheaper, then it means you will get extra amount in maturity. Alongside this interest you're getting every 6 months, at maturity you get higher amount. You buy at 48, board face value is 50,000. You get 50,000, not the 48 you paid for that board. So you have extra 2,000 that you're getting as profit. Now add that to your interest. It gives you your real returns. Board's returns is not the coupon. It is the yield. That is coupon plus either the discount you get because you buy cheaper, you get the full amount at the end. What about the amounts you pay extra, like when you place a bid 50 and CBK asks for payment of 53? Aye, 53, unless there is at CBK. Unless there is extra charges, and it should have been disclosed to you. Unless there is a charges. If it is secondary market, it is the broker who is asking you for that fee. First of all, the person who is selling to you, remember you have to pay interest, so the 3,000 includes the part interest. There is also broker commission. If it is about you buy through a broker, 3,000 includes, first of all, the interest, the board holder, broker commission and levies. And also if the board holder also wants to sell at a profit. There is no other extra amount you are supposed to pay if you are doing through primaries. Secondary market, of course, you either pay high or low. If it is secondary market, that extra amount is not to CBK. It is to the board holder. Yes, you pay to the CBK to pay the board holder. If you buy higher or lower than what CBK is selling at, you'll be buying in the secondary market. My question would be, why would I buy at a higher price than CBK price, where CBK will only pay you back 50,000? The question is, there is no boards that have been opened or reopened, and you need to buy a board. It means you have to buy in secondary market. Go to a broker, they will only tell you I have this board at this price, I don't have any other. What will you do when you need a board? That's the only time you buy at a high price. Otherwise, any other time, always check, are there other boards? You can get that information on boards price list from NSE. It shows you the boards which have traded. If you go to CBK website and also on your account, do CSG account, you can see the boards which are actively trading. So mostly if you are paying more than the board face value, it means you're buying from a broker or a board dealer. That's why I said in primary market, never ever let a broker do that application for you, because you have to pay them. Even if you pay money directly to CBK, they will send you another bill. You see it in your account as a debt that you need to pay commission. Primaries, jifanyie, there is nothing you are doing extraordinary. You're just clicking there, put the amount. If it is allotted, you pay. With that, let me see time. Let me open maybe audio for a few For those who may want to ask the questions, the floor is open. You can unmute as I take a cup of water. If you have any question, you can unmute. Silence means we have understood, but next week I will let you know the dates. We'll do now the practicals. Practicals. That time there will be no theory. It will be pure practicals. Na itakuwa na ka exam. These days I think we'll be doing ka exam so that tunaona whether we have understood. It will be just a simple question. We see if we have all understood. Just to make it interactive and also to jog you. But I'm always available on that WhatsApp number. As I said, I'm not charging anything. Reach out, reach out, reach out. Understand these investments, because you have so many investments. You have shares, already shares we have covered. You have boards now. You have international markets. I'll be doing that training tomorrow. I post the poster today. I didn't want to post them so that we don't confuse people. So tomorrow, international markets, we go through funding and identifying now opportunities. We see some of the stocks you can buy. Then after that, we come back to shares. So now we'll be revolving that. And tomorrow, we'll also be going through pension. Brief introduction on pension, so that also you take care of your retirement. Because we really forget, we want returns from the market, we forget our retirement. We are headed there at one point. Don't forget that. Bonds you hold for 30 years, maybe that's the time you're retiring. What do? Even if you get your money back, if you had invested separately, then you have many ways of taking care of your retirement. There is a question. I opened account, but it's dormant. Is that a problem? If it is the IB's account, that is for shares. It's not for boards. If it is at CBK, you can always write to them. They can deactivate. For AIB account, just reach out on WhatsApp. I can share an email address where you can send the request. It will be activated. I opened a DO account but did not understand how to buy. Now I do. Welcome, welcome. And next week now we do it practically. Now you know how to select the boards. If my account will be able to, if there is any board which will be open that day, we can do some bidding. Secondary market, unfortunately, it goes through board dealers. But at least now you have the basics. When we do practicals next week, when you're calling the broker, you only ask them, I need this board, give me YTM and data price. That time you don't even need green price, you already know it. Even that board dealer will be worried. With that, then we can call it a day. This video will be uploaded. I will also be sharing these notes. And also for the previous sessions, I'll also share the notes. I know I forgot to share the notes. The notes are free. Ebook is the one which is which I'm just to support the community. That is the link for the ebook. Because I also want to do, it's only that I don't want to disclose here so that others don't rush and block me. The other things I also want to do to make sure now it is a full community. There is a question, when you get your board money later in life retirement age, where do you put these monies? At retirement, it is you now to decide. Remember, you put 100,000, you receive it after 50 years, maybe at retirement. It's your money. Maybe that time You want to take your kids to university, you have money. That time you want to go to a trip maybe where you have never gone, maybe Canada, US, that time that's the money to use. Maybe that time is the time you want to spoil yourself. It's your money. You can even bring that money back to shares or you invest in another bond. Shares and bonds, they never get lost. Remember, the bond will be paid back to your bank account. The only thing that can happen if you're not there, if the bank closes that bank account, and that money will be sent to an unclaimed asset. If the beneficiaries don't claim it, you can invest in shares which never go anywhere. So you get your money back, put in shares, leave the shares to your beneficiaries. Does screen price and data price also apply to corporate bonds, commercial papers? Yes. Everything we have run here applies to corporate bonds. Only now the difference is it's company you are owning to. So the price is also based on interest because you have to pay the person who is holding that bond. You also have to pay commissions. Again, it goes through the brokers. And I believe next week let's do for both corporate board and government board as an example. So hopefully I've answered all your questions. And thank you so much for supporting community by joining in and also contributing. And ask the questions on all groups. I know we are from different groups. Just ask within that group. I will help you. Other investors will help you where I'm not able so that we grow together. Thank you so much. And let's meet tomorrow for those who will be joining. And have a wonderful weekend. Bye-bye.